Hey traders, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Wednesday, October 25, 2023. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. What do we have on the docket today? A lot of stuff. They made another new low today. Let's get it right out on the table. The market is in that place where the rubber band basically has broken. It's breaking. You can look at it any way you want. They're either going to have a rescue operation, a kind of a right here, right now situation, or there's a lot lower coming, and it can happen. Doesn't have to happen. It can happen rather quickly. She's below all the moving averages on the daily chart. The trend is your friend. We'll see what Friday brings, but here's your weekly chart closing below the convergence of the 150 period moving average would certainly be another negative signal. We don't know whether that will happen. They could spike it on Thursday. By Friday's close, they could close back above it. We don't know. We have to wait to find out, but it's an important place that right now is an awareness. First, giving up the former lows was a problem. Then, all of a sudden, making a new low, now giving up the new low, which we have now a third new low situation. That's a bearish lower low situation. Not trying to be Captain Obvious or anything. We're just talking through the charts. Just go back to, if they get below these lows, that's the Irene situation. Irene is unfolding. Will she continue to unfold? Good night, Irene, is the point. The only thing left is a rescue operation. It can happen. It doesn't have to happen. It can come out of nowhere, but the market is in that rubber band stretched too far place. A lot of discussion these days around the inverted yield curve situation. What are they talking about? Well, there's different renditions. The majority of the time when you hear inverted yield curve, it's 2s and 10s. That's what you hear most of the time, 2s and 10s, 2s and 5s, 2s and 10s for the most part. 2-year yield never got to my number, 5.282, however, came very close, but the 2-year yield, closing price today, 5.116. In trader terms, 5.116. The 10-year, on the other hand, did get to the place. They're still hanging around the place. The place is no longer important because they already reached the place. First time, best time. 10-year yield, closing print today, 4.946, 4.946. It's inverted. The 2-year has a higher yield than the 10-year. The Fed's fund rate is 5.33, higher than the 2-year, higher than the 10-year. You've got an inverted yield curve situation. You'll hear every time there's an inverted yield curve, it guarantees a recession, all that stuff. That's all true stuff, but here's the rub. By the time that you and I and Uncle Joe finds out that there's a recession, we'll find out a quarter or two late. The market will have already bottomed and been on the way back up. That's the way these things unfold, like it or not. So let's say they can't rescue the thing. The rubber band really does snap, and all of a sudden we get into a rapid decline situation. Where's she going? Nothing's changed. It's in and around the 400 neighborhood. They can certainly spike it. They can certainly come up short. But when you talk about a move that big of, let's say, 150, 175, 200 S&P handles, the give or take is in dollars. It's $2, $3, $4, $5, give or take, if it happens that kind of rapid fashion. We looked at this last night. The 200 period moving average is below 400. It's, let's call it 394 for argument's sake. Can they get there if this thing snaps? Yeah, they can. Will they? We have no idea. Sometimes they come up short. Other times they spike them through. We're just in the preparation phase of the just-in-caser. It's not easy to trade the market for that type of situation. There are traders, for example, in the live room, we talk about this from time to time, they'll buy a lottery ticket. What's a lottery ticket? You say, all right, I'm willing to put up $200, $500, $1,000, whatever your number is. It's a bet. You're going to buy puts. They're going to be Friday expiration or next Friday expiration. You're going to put whatever you're going to put into it. You're going to assume you're going to lose. And if it happens, it happens. That's called a bet. It's a lottery ticket. It's not a trade. It's just a way that you can participate for the just-in-caser. These type of things do happen. They just don't happen all that often. They're very, very difficult to catch from a trading perspective. They generally don't want you on the bus. They generally try and shake you off the bus. They do a pretty good job at it. What else happened today? Well, this morning, part of the market broke. What does that mean? Some of you may not be aware. The options market froze up. Something happened at the CBOE, whether it was a software issue, whatever it was. And by the way, we'll never really know the full story. Whatever it was, shut down the options market, thus the VIX stopped trading, and something was weird in the market. It definitely filtered through and affected the SPY, maybe a lot of other things, but we were watching it, and there was just some weird stuff going on, and it lasted for a little bit of while, cleared up, and business went forward. And here's the information that I suggested to the live room members and Inside the Number members today after that occurrence. I said, putting your capital up in a market, betting that they've fixed the technology issue is not necessarily a wise decision today. In other words, they had a tech problem, the market froze, a lot of traders got lucky and were able to get out of a position. Some traders took a hit as a result of this thing happening. Sometimes you say, you know what, this isn't a tradable market today. I'm going to take my capital and move on to tomorrow. Who needs the variable risk of their technology issue? That's basically the way I left it with the members. I'm going to run through the notes. We'll highlight a couple of important things here and there, but we're not going to belabor the point as a result of those issues this morning. You can pause the video, read the notes, go back to the chart, and double check the work. You'll find that the numbers worked. It's just, at least in my opinion, based on what happened this morning, the market was a little bit squirrely leading up into the actual issue that happened with the CBOE. So I don't think it was on the spur of the moment and then there's a problem. I think there was a problem and then we knew what the problem was. Here's an example. Below 419.60 is where we start talking failure. Closing candles, staying below, the spike doesn't do the trick. 419.60 was that semi-uncle point this morning. We talked about it in the live room. It was posted in the notes. We think better in picture, so right of the vertical is today's activity. You can see here the 419.60. We were in a trade up here. The market scaled down. We had an uncle point. It was they can't stay below here for very long. This is the last line of defense. Stayed below a little bit, but they never really started pushing below. A lot of traders, many traders, most traders hung in there, and they finally got the bounce. Were able to get a profit, break even. Some actually made a decent profit altogether. But the intent this morning wasn't for the market to get down that low. So whether my number was wrong this morning or there was something where the issue caused the market to go a little bit lower than it normally would have under the conditions there were, who's to say 419.60 saved the day in a lot of many different ways. A lot of many. You like that one? Write that down. Put it on a sticky note. Pause the video, read the notes, go back to the chart, and double check the work. You'll see a lot of the stuff in here. The numbers were working. It's just issue central with the market today. 421.25 was another important place. Why? That was the entry point. They got us back to the entry point. And you'll see it in the notes. Read the notes. You'll see it. And then you had the failure into the remaining part of the day. What's going on over in Camp IWM? Well, they hit the official completion of the Head and Shoulders target. Doesn't mean they can't go a little lower, but from an official standpoint, whether I was right at 164.20, whether it was 164.35, whether it was 164.02. They got it all done. They spiked below 164, closed down here. Now keep in mind, that doesn't mean they have to bounce the market. That was the target from the head and shoulders formation. This is finished. It completed. You look at the weekly chart and you can see here the last line of defense over here are these pivots where the market told us that these places are important. You give up these places, the next number we have is 158 and change. These are defense type places. There has to be a rescue around this pivot low here, which is 162.50. They're close. This pivot low is 162.78. So you can see twice the market bounced off these numbers. Is it going to do it a third time? We don't know. If it doesn't, it's 158 and or lower. Remember, we talked about this a number of times. This was a bearish wedgish formation. They broke the bottom. This thing from the top can actually get a whole lot lower. This is a monthly chart, so keep in mind, these things take a long time to play out. This one could simply tag and touch the 100 period moving average and bounce off. Ironically enough, there are no accidents or coincidences below the completion of the head and shoulders formation, and the next number down is that 100-month moving average. Should be rather important, shouldn't be bona fide support because they rode it for a long time, but the market still knows about it. It's just not the same trading opportunity it would have been several months ago. We can play a little game here with a longer-term chart, a 3-month chart, and I could see market symmetry down to the 50 period on the 3-month chart moving average. You can see it here. You have a wedge pattern after a move down, and you can have another move down of equidistant. This is market symmetry. It's taught in the course, Lazy E-mini Trader. All charts act and react the same way. We don't know that that will happen, but if that did happen, it would be an interesting place where the market may find some kind of a bottom, at least for a period of time. What's going on with the folks down at the transportation department? They got below my number, below the target. They had to get to 14,060. They got below it, stayed below it. They got what's called thumped today. That's a technical term. You look at the longer term chart and it's a pretty simple equation. These lows here, the market told us many times that this area was important. Now you have a 200 period moving average right around the lows. The actual low here and this pivot low was 13.4. You have a 200 period moving average. So that should provide some semblance of support. You look at a daily chart, that's a long way down from where they are. Doesn't look that far on a weekly. On a daily chart, it is pretty far. Markets across the board are going to need a rescue operation for the bull case if there's a bull case, if there's a bottom coming. They come out of nowhere. Sometimes they come overnight. Sometimes they come in the middle of the day. If they don't get a rescue, you're going to continue to see the same routine over and over and over again. Without the rescue, the selling will accelerate. What about the Q people? Interesting development today. They closed below the low from the other day. So this low and this low were in focus the other day. They held the first low the other day. Now they just gave it up. Obviously negative sign, not to be Captain Obvious, but last line of defense is all the way down here from a moving average perspective. And look at this. All this area here was already tested and it worked. This was a breakout area. The market came back to test it and it bounced. Now you're at the bottom end of this area again. What's next? If you continue lower, the next thing from a candle perspective happens to be this breakup candle low around 340 and change. Call it 340.60, 341, 340, whatever it is, it's in that neighborhood. There's a little gap down there also. The gap would be at 341, just a spike below 340. And just so happens that your 200 period moving average is right there, which will be edging up each and every day. So it's right around that 340, give or take, area if the market comes down here in the next several days. From a visual perspective, if nothing else, 340 is a big spot. What's a bigger spot from a weekly chart perspective? Well, here it is. You have this pivot high over here at 334.42. So we'll just say it's in this general area. You draw a line straight over, and we don't know exactly where these moving averages will be, if price, when price gets there, but this is also a bona fide breakout area. Spike it, touch a moving average, close the week above, something like that. That's possible. That's the way these things normally work. If you find the cues down in this neck of the woods anytime soon, it should be the area where we'll see a bull-bear battle ensue. Write this down. Put it on a sticky note. XLF wasn't that bad today in terms of percentage down, only down about 1/3%. But what are they doing? Well, they're below all the moving averages, just eating time off the clock. So if there's no rescue, they're just going to go down. The alternative of a rescue is what? No rescue. You know, we looked at this last night, the XBD, which is the broker-dealer index. And interestingly enough, it's showing up about $2.50 on the day. And why is that interesting? Because we're finding this across the financials. Notwithstanding everything else that was going on, the XLF didn't get killed today. The XBD was up. And another one we looked at last night was the KRE. The KRE finished down 14 cents. Was lower, finished almost to the flat line. So something's going on in the financial sector. It could be a canary in the coal mine. This is still a terrible chart. There's no two ways about it. But they're going to get a reversal from somewhere. Is it here or is it lower? We don't know yet, but there will be a reversal from somewhere. There always is. When you look at the weekly chart, will it be from new lows or a higher low? That's what's on the table. The XBD, broker-dealer index, holding the last moving average line of defense before these lows and the 200-period moving average. Could it be a higher low situation? This is essentially an uptrend until they really break the chain. They're close. That's what essentially will break the chain, this trend line. The reason why we're looking at some extra stuff is there's always going to be a canary in the coal mine. If it's not the normal canary in the coal mine, such as the transports, which are a good and my favorite canary in the coal mine, sometimes it's found elsewhere. Semiconductors, financials. The semis are a good proxy for the tech space. The financials are a big part of the S&P, can certainly be a canary. Country doesn't operate without the financials, nor does the world for that matter. Speaking of the semis or smash mouth, they got whacked pretty good today. That's a technical term. Down almost 4%, heading for where? Last moving average line of defense on the daily chart. Pretty obvious, 200-period moving average. Right here. Call it 137. Now, here's where we are. Let's say they start pushing it through, and this is your last line of defense, right? Below that moving average, slightly, it's on that moving average. That's your last line of defense before no man's land all the way down to the gap. You'll normally get a bull-bear battle here before entering no man's land. Doesn't look like much on the weekly chart. What it looks like is if they continue down, they're going to get to the 50-period moving average down here. That's the blue sloping trend line right around 132. What else is around 132? Check this out. Is this a breakout area? You betcha. How so? Market runs up to this place, pulls back for, let's just say, couple of months, breaks out, rallies, coming back 50-period moving average, breakout area 131, 132, give or take. In this area is that place. And guess what you have also? A little bit lower, you have a breakup candle low coming in at 128. What do you have down here? 100-period moving average just below that. So there's a ton of stuff in here to give reason that if the rubber band does crack, this is an area where smash mouth should find some bona fide support. We're going over all this stuff because it is the possible. You need to know where the places are and be prepared for the what if. If I told you how much I appreciate each and every one of you, without you, these videos are not possible. That is true and accurate information. We're pulling the ripcord here today. I'm David Frost, my strategic forecast. Thanks again for tuning in to another episode of Common Sense Market Analysis.